Hey guys, it's John McGuinness from Living La Jolla, La Jolla's premier real estate show. We're back for another episode of Quick Tips where we answer real questions from our real audience. Today's question is about financing contingencies. What's a financing contingency? Let's check it out. So many of you know we are in an economic time where things are changing big time. Interest rates are on the rise and everyone's not really sure what's going to happen next. Now more than ever, it's so important for you to build a financing contingency into your offer so you don't get screwed later on. So what's a contingency? A contingency is basically the principle of saying in order for X to happen, Y has to happen first. In the case with a financing contingency in your real estate transaction, you're going to basically say in order for me to buy this house, I got to get the financing first. This is really important because when you sign a contract to buy a property, you're going to deliver an escrow deposit. Now, if you don't get the financing to buy that home, don't you want the deposit back? Yes, of course you do. Remember, just because you're pre-approved to buy a property doesn't mean you're guaranteed to get the money on the closing day. Many things have to go right, okay? And your financing contingency is there to protect you in the case things don't go right. The basic way I like to structure a financing contingency is based on a minimum loan amount, usually 80% of the purchase price. This protects the buyer in two different ways. One, if for some unforeseen circumstance they don't qualify for the money anymore, like they lose their job or they have some major financial event that causes them to not qualify, then the bank's not going to give them the 80% of the purchase price anymore. Then the buyer can simply cancel the contract, back out, and get their money back. The second way this protects the buyer is in the case of a low appraisal. All right, say you're buying a home for $1 million. That's the contract price. But the appraisal comes back from the bank, and the appraisal is lower. It's only $950,000. Now the bank is only going to give you a loan up to 80% of whatever number is lower, either the contract price or the bank appraisal price. Okay, in this case, the bank appraisal price is lower. So the bank is going to give you 80% of $950,000, which is only $760,000. Now, remember, this deal was contingent on you getting 80% of $1 million, which is $800,000, but the bank's only willing to give you $760,000. So in this case, the buyer can enact the financing contingency and cancel the contract if they wanted to. A lot of times, in a case like this, the seller and the buyer go back to the negotiating table, but at least the buyer has the ability to back out should they decide to. All right, that's financing contingencies for now. If you guys have any other questions, feel free to shoot me a message or a DM or comment below. Don't forget to subscribe. That's it for me for now. This is John McGuinness from Living La Jolla. Talk to you soon.